Ondas Inc. stock, trading under the ticker symbol ONDS, is currently priced at $9.21 during the intraday session, marking a steep single-day decline of 16.42%, with the market open and active today on June 17, 2026. While a drop of this magnitude usually sends casual retail investors rushing to panic sell their positions on popular investing sites, the real institutional players looking at data terminal feeds see a vastly different narrative unfolding behind this massive daily swing. The headline numbers suggest a sudden collapse in confidence, but the underlying tape tells us that this drop is actually a high-volume collision between aggressive structural share dilution and a fundamental business turnaround that just saw quarterly revenues skyrocket by over 1,000%. It is the classic example of a market overreacting to short-term mechanical pressures while completely mispricing a massive multi-million-dollar defense backlog that is quietly positioning the company to dominate the automated drone and tactical communication landscape. When you scan the sentiment across standard retail platforms, the general expectation among the crowd is that the company is falling into a toxic death spiral of endless share printing and executive cashing out. Investors look at the recent regulatory filings showing massive share resales and the CEO parting with millions of dollars in stock, assuming the worst about the company's internal stability. But the underlying reality is far more nuanced, presenting a classic structural trap that rewards patient capital while flushing out weak hand. The true driver behind this intraday sell-off is not an operational failure, but rather the hard mechanical digestion of its recent high-profile acquisitions of Mistral and Omnisys. These mergers required issuing millions of new shares to select institutional sellers, who are now aggressively locking in profits, causing artificial downward pressure that completely disconnects from the company's true operational trajectory. If you open up standard retail apps or check out tools like the Robinhood app, it is easy to get caught up in the purely emotional day-to-day momentum of small-cap tech. Most casual traders looking for investment help throw their money at names like Tesla stock or Apple stock because they represent safe, highly liquid mega-cap stability. But when you step into the world of self-investing and actively select micro to mid-cap defense contractors, you have to be prepared to navigate these hyper-volatile structural storms. The heavy volume dragging the price down today reflects a massive block of stock hitting the market all at once, creating a temporary supply imbalance. Experienced traders using advanced setups like the Interactive Brokers platform know that these moments of structural dislocation are exactly where asymmetric risk-to-reward setups are born, standing in sharp contrast to the slow, algorithmic rebalancing you find in a generic robo-advisor product like Schwab Intelligent Portfolios. To truly understand what is happening right now, we have to contrast the public market narrative against the hard financial realities buried inside the latest quarterly reports. The public expectation was that Ondas would remain a small, speculative pre-revenue drone startup burning through cash with no path to profitability. The reality, however, completely shattered that view when the company reported first-quarter revenues of $50.1 million, representing an astronomical growth rate that completely outclassed its historical performance. Management was so confident in this operational trajectory that they raised their full-year revenue guidance to at least $390 million, backed by a massive pro forma backlog of $457 million. This means the forward-looking valuation multiples are rapidly shrinking, making the stock look remarkably cheap relative to its true commercial growth path, even as short-term traders dump shares in fear. This massive disconnect has turned the stock into a prime battleground for short sellers and institutional block accumulation, creating a volatile trading environment that is heavily showing up across major platforms like Fidelity Investments. High-end tools like the Fidelity trading platform show a massive spike in institutional order flow, indicating that while retail investors are panic selling their fractional shares, sophisticated funds are quietly scooping up block positions at a deep discount. The short interest on the stock has ballooned to roughly 32%, creating a highly wound spring where any positive operational update or surprise contract win could trigger a massive violent short squeeze. This is the exact type of structural setup that makes online investing so fascinating, as the tension between short-term mechanical selling and long-term fundamental value reaches a boiling point. When you look at how people manage an individual brokerage account today, they often rely on simple automated indicators that fail to capture the complex capital structures of growing defense tech companies. If you are using standard wealth management services or basic portfolios, you might see this daily drop as a signal to avoid the asset entirely. However, active traders managing their own positions on platforms like SoFi Invest or using specialized Fidelity mutual funds know that defense technology and autonomous infrastructure are experiencing a secular multi-year tailwind. Government agencies and international defense bodies are aggressively ramping up spending on unmanned aerial systems and automated perimeter security, creating a massive commercial runway for the few companies that possess fully certified, field-ready technology. Let's hit pause for a second, because I want to hear from you on this specific point. Go ahead and comment below how many shares of Ondas Inc. you currently hold in your portfolio, or if you are planning to avoid this volatility entirely. It's always fascinating to see how many people are playing the small-cap defense space versus sticking to megacaps like Nvidia stock. To understand the core engine driving this business, we need to look closely at what the company actually does and how its dual-platform business model operates in the real world. Ondas operates through two distinct, highly strategic business segments that solve massive structural problems for industrial and government clients. The first is its software-defined radio technology, known as the FullMAX platform, which provides secure, private, wide-area wireless broadband networks for mission-critical infrastructure, like railroads, oil and gas fields, and maritime ports. This is not generic Wi-Fi. This is highly secure, specialized communication infrastructure designed to prevent cyber attacks and ensure continuous connectivity across thousands of miles of industrial territory. It creates a highly sticky, high-margin recurring revenue stream because once an industrial giant installs this radio network, they are locked into the ecosystem for decades. The second, and perhaps most exciting part of the business, is its autonomous drone division, operating under the American Drone and Ondas Autonomous Systems banners. This segment features the Optimus system, a fully automated drone-in-a-box solution that can launch, fly pre-programmed security and data collection missions, land, recharge, and process data, all without a human pilot on site. This technology is being deployed for advanced security, industrial inspection, and maritime surveillance, recently securing a multi-million-dollar contract for maritime operations. By combining secure, long-range communication networks with fully autonomous robotic hardware, the company has built a comprehensive ecosystem that directly addresses the global demand for localized autonomous security infrastructure, allowing them to scale rapidly in an environment starved for domestic drone solutions. When you analyze the past performance and older financial history of the stock, you can clearly see why the broader market has been so slow to trust the current turnaround. For years, the company was characterized by minimal revenue, high research and development costs, and an ongoing need to raise capital by issuing new equity. This historical track record created a deeply ingrained market narrative that the company was simply a speculative cash burner, a view that still dominates the analysis found on generic investing sites and basic stock screeners. Many investors who bought in during previous market cycles were burned by subsequent share offerings, leading to a long-standing psychological resistance to buying the stock, regardless of how much the underlying fundamentals improved. This historical baggage is exactly why the current explosion in revenue and backlog has caught so many casual market participants completely off guard. Looking forward into the final half of the year, the future outlook for the company will be entirely dictated by how successfully reality continues to outpace these deeply entrenched skeptical expectations. There are two primary scenarios that investors must carefully weigh when managing their risk profiles on platforms like the Interactive Brokers platform or the Robinhood app. In the bullish scenario, the company successfully executes on its $457 million backlog, smoothly integrates the technology from its recent acquisitions, and proves to Wall Street that its massive revenue growth is sustainable and structurally profitable. As these numbers hit the financial statements over the next few quarters, institutional analysts will be forced to re-rate the stock, potentially driving it toward the median price targets that sit significantly higher than today's depressed intraday price. Conversely, the bearish scenario revolves around the very real execution risks of share dilution and corporate integration that are causing today's sharp sell-off. If the company continues to register millions of additional shares for resale to fund its rapid expansion, the sheer supply of stock on the market could outpace institutional demand, capping any meaningful price appreciation regardless of how many new contracts are secured. Furthermore, integrating international defense technology acquisitions is a notoriously difficult process that can face regulatory hurdles, supply chain bottlenecks, and sudden shifts in government defense budgets. Investors trading this asset through a self-investing strategy must closely monitor the upcoming quarterly reports to ensure that administrative costs do not swallow up the newly found revenue gains. When you look at the broader macro environment, the company is operating with a powerful tailwind that few other small-cap tech companies can match. Global defense budgets are rewriting their strategic priorities to focus heavily on autonomous hardware and secure digital communication, making the company's product suite highly relevant to modern procurement officers. While giant funds shifting capital through generic fidelity ETFs might overlook a company of this size, active small-cap managers are taking notice of the massive structural shift occurring under the hood. The tension between the short-term pain of technical share dilution and the long-term beauty of a surging defense backlog is what makes this specific asset one of the most polarizing and analytically rich stories in the market today. In summary, the central insight of today's dramatic trading action reveals a profound contrast between market expectation and fundamental reality. The broad market looks at the 16.42% drop to 921 and expects a failing, diluted tech stock that is running out of options. The deeper fundamental reality shows a company growing its revenue at a triple-digit clip, holding a massive backlog of contracted business, and experiencing a temporary technical sell-off driven by institutional sellers cleaning up post-merger equity positions.
For those looking at the market through the lens of long-term structural value, these moments of severe emotional dislocation are precisely where the line between surface-level panic and deep analytical conviction is drawn, leaving a lasting sense of authority for those who know exactly what they own.